But today we're going to talk about cost segregation. And the thing is, we want to be very interactive. So if you have any questions, comments, or experience, we would love to hear about what you have to say. My name is Matthew Warren. I'm a tax CPA. I say tax CPA because I want to tell people that I am focus on tax, but we do also bookkeeping, accounting, and various types of work for clients, but tax is the big thing. I am a CPA, but also an enrolled agent with the IRS, with the Department of Treasury. That helps me to be able to practice tax across the United States, not just in California. We really want to help individuals and small businesses reduce their tax liability and be able to create, deploy their funds and assets to create a lasting legacy. We have our new logos there. The mountains to see, it's literally our Saddleback Mountains to the ocean. That's the territory that I'm claiming after having worked across the United States for several years. But let's get into the cost segregation stuff. So this is a bit of a word dump now. We're not going to go into every slide here, or into every word here on the slide, but we wanted to get a basic overview of what cost segregation is. So let's say we have a renter that buys a property, and then they're going to rent it out. And let's say that they're a real estate professional. They're considered a real estate professional. They're not passive in this business. I think a lot of people here are active participants in the business. But you purchase the property. Let's say it's for $1 million. Now in that property, the land value might be 30% of that. Now you all know better what the rates are these days. But let's say the land value is going to be 30% of that, like $300,000, and then the building value will be $700,000. Within that building, there are different assets and structures that have different levels, durations of depreciation. So the walls, like the actual wooden frame structure, that's the 29-year property, or 27.5-year property, or in the case of your short-term rentals, that's going to be 39 years. But then a lot of other stuff, like if you think about the countertops and landscaping and flooring and bathroom fixtures and things like that, those are going to be 5, 7, and 15-year properties typically. And so the benefit there is with the current tax landscape with bonus depreciation, we can take the bonus depreciation for that immediately in the year that the property is placed into service. Now, placed into service is a very important term, but and we can get into that more detail. But the date and the year that it's placed into service, we can take that bonus depreciation, and then the bonus depreciation is typically around 30 to 40% of the building value. So, or yeah, 20 to 40%, I would say. So if we take that, if we go back to that $1 million property, $700,000 building value, about 30 to 40% of that might be property that we can immediately depreciate, and that means that we can take a depreciation deduction off of our income for that amount. And the cool thing about this, it's very powerful, which that depreciation, that deduction that can be taken can offset ordinary income. So I have people that make, well, we have an example here. I have had a client that makes around $500,000 a year with W-2, but then buys a property and then takes the bonus depreciation. In this case, it was a $700,000 property. We're able to take about $180,000 for the bonus depreciation, and then that offsets their ordinary income, so it reduced their taxable income by about $180,000. We'll get into more detail on that in a moment. But some of the rules, like so. I say generally you must be a real estate professional. Now you can do a cost seg and not be a real estate professional. The problem is you're going to be limited by your income. You'll still be deferring that for a long time. Again, it's based on placed in service. Now the newest rules are based on placed in service as of January 20th of 2025, but there is an election that exists for if you purchased a property early, and we do have scenarios about that. And so again, extraordinary claims require extraordinary evidence. These are the main sources of authority. Let me get back to that. The main authorities that you can go to for a lot of this are out there, so I want to be able to show you that. But in any event, these are some of the things about costing. Now, let me stop there. I'm talking a lot, and I mumble a lot, and you'll excuse me. Questions? Yes, sir.
Yeah, so you were saying like countertops, you get 5 to 10 years. Could you do cost segregation more than once on the same house?
Yes, sir. In fact, what we're going to talk about is what's called a partial. I have the term for it later, but it's a partial it's a partial situation where you're removing something that has value. Like if you, let's say you have countertops that are like granite. Okay, I have granite countertops. I'm removing the countertops. That has value, and then you're replacing it with quartz. All right, so you're gonna replace that something that has value with something with more value. And there's a value to what you're basically destroying, and then there's a value of what you're replacing. But yet the answer is yes, and there is a scheme where you have to take back some of what you previously deducted, and then you can add it with that other thing. But we can talk about that a little bit later. Does that make sense at all?
It does.
Okay. Did somebody else have anything? Okay. All right, so wanted to keep this very interactive. By the way, interrupt the heck out of me. I love it when people interrupt. You know, this is really all about you. It's not about me. But who has done a cost segregation study about here? Yes, sir. Anybody else done one? Is there anything that you could share about the cost segregation one you did that was enlightening or?
Yeah, so when I did it, I mean, I just worked in accounting. It was a property that I merged in Indiana
Okay.
when I was like 21.
Nice.
But I had pretty high income that year, and I basically paid nothing. Or
Nice.
Nothing.
Yeah.
So it was amazing. But I feel like if you're going to do it, you have to pretty much keep the property or 1031 it, right?
That's correct. And we have a few strategies around that coming up. Yeah.
Oh, I do have a question as well.
Yeah.
So can you do it across any real estate asset class, or is it primarily created for like single family residential?
Yeah, in fact, the answer to your question is basically any real estate class. In fact, like what we're talking about really here is bonus depreciation in general, but we really want to make it specific to cost segregation and the assets related to that. But there are we can get into some very interesting rules. I want you to be at least aware of these. For instance, if you buy a factory, there are special rules that actually make it more beneficial to do a cost seg in a factory building because of some options that exist on how that cost segregation is done. But for those of us that are doing single family homes, things like that, it's also an option. Yes, sir.
Just confirming, this only applies to investment properties or also primary residence?
This is for investment properties. Yeah, that's right. Good questions. Anybody else? All right, let's keep going. All right, this is a real world example. Back to that, so the taxpayer makes around $450,000. They purchase a cabin in this case, and the land value is $200K, building value $500. They perform the cost segregation study. By the way, one of the outcomes of the cost segregation study is a IRS cost segregation report. It has to be in a specific format. It has to be approved by the IRS, and that's one of the deliverables. So you actually get something out of it. So they perform the cost, and so it turns out that they had about $186,000 of assets that were in the 5, 7, and 15-year category. So that reduced their taxable income by $186,000. So for the taxpayer, it effectively gave them a $55,000 tax savings. So that's a real-world example. Now, and we definitely do need to talk about recapture recapture and also 1031 exchanges, but we'll get to that. So there are ways to deal with that. Let's say if you do sell the property after you do a cost segregation, you want to have something around that. But like I said, be cautious of sensationalistic claims. Like I'm a tax person, I actually have to do these returns, and I found a couple little scenarios which are gotchas that are not easy to explain, and they're not easy to receive by the person receiving the information. So for instance, if you have limited income, then we might have to carry that over to another year. Or in the case of some other kinds of depreciation, if you take bonus depreciation but you don't have that much money at risk, then you're limited. So there's a few different things. Be careful about that. Now, contingent fees can be predatory. Now, when I say contingent fees can be predatory, contingency fees are a standard part of service providers. That's not a bad thing in and of itself. A contingency fee is like, if I find you $100,000, you give me 25% of that, versus if I'm going to help you find $100,000, but you pay me $15,000 to do it. So there's this contingency fee. But if they're asking for a contingency fee, I find that it could be a little sketchy. Be careful about that. What we do is we like to do is a fixed fee when we do these services. And let me stop there. Any questions or comments? Yes.
How much does it normally cost to get a cost segregation report done by a company?
Yeah, that's a great question. I have another slide coming up here. Yeah, the very next slide. That's the best segue ever, Patrick. Thank you. But yeah, we do have some typical prices. So when I'm talking about single family homes, and I'm talking about like maybe apartments up to about 10 doors, or I think another way to look at it, let's think of it as like 1.5 million or less. Now I know we're in California, 1.5 million or less is becoming a unicorn. But let's think about 1.5 million or less. So like you can do a bare bones, like, you know, it's basically AI-based thing that costs about $1,200, not recommended. The most common one is what we call engineer reviewed. It's more comprehensive. You're taking a lot more measurements. You're taking pictures. You're documenting everything. And that's typically around $2,500 to $3,500 for a single family home or a small number of doors for a multifamily. And then when you get into some really high-end stuff, just to get your foot in the door would be about $5,000 to $10,000. Like if you talk about anything in Newport Coast would probably be $20,000 to $50,000 to do. Whereas something like in Irvine that's like highly customized, that still might be a $10,000 to $20,000 operation. But for most properties, you're talking about even if they're more high end, a lot of times for single family homes it could be around $5,000 to $10,000. Does that make sense? Okay. We'll go into some examples. So let's go into like applying the right kind of study. Now I don't know if you all could see these pictures, but so let's take these two pictures. So above you got like let's think of like the rock star pool. Like the rock star. This is like Taylor Swift's pool or something like that. And the bottom one is a standard pool. So like let's think of it. So if we were to think about an engineered study versus like engineer reviewed study, what do we think the top one's going to be? Is that going to be the engineered or engineer reviewed? Exactly. We got it. Everybody's a fast learner around here. But yeah, so if you're doing something that's heavily customized, you definitely want to do the full-on engineered study. Whereas like a basic pool, yeah, you can. And by the way, some of the people among us will note that a pool happens to have a 29-year lifespan, so it isn't depreciated anyway with the bonus depreciation. But all the hardscaping and things around it would be depreciated over a 15-year period. So, but in any event, I wanted to give the example, like kind of a ludicrous example of where you'd want to do that. We'll keep going here. Okay. So some of the scenarios that we can do. So, like I said, I think the ideal scenario for cost segregation, I need to do a cost segregation if I'm a new renter with REP status, I'm a real estate professional status, and I have a new rental unit that I want to take some depreciation on now. So that's the ideal scenario. So that's that top purple guy. A few other scenarios are, so you have a passive renter. So in the case of a passive renter, the deductions are going to be very limited, especially when they buy a new property. Like in California, they're going to be upside down for a few years in terms of rental income and things like that. They might be net negative for a few years. They might not benefit hardly at all from that. Whereas the person who has REP status is going to be able to benefit from that. And then another thing that we want to talk about is the short-term rental. So a lot of people will call this the short-term rental loophole. Now, I'm not a fan of the word loophole because when something is coded into the tax law, it's for a reason. So the short-term rental exception, which allows people to put 100 hours into their rentals, and then they can be an active participant in that and it's an active trader business, they can take that bonus depreciation. Now, why would and the thing is, we all know that the government doesn't do something because they're nice. They're not doing it to be nice. What they're doing is they're trying to foster a certain kind of business and innovation to take place to help spur on the economy. So that's why. Whereas with a REP status where you have to have 750 hours in a year, with the short-term rentals, if you buy that Airbnb property, you only have to put in 100 hours. Really cool feature. But let's think about if you bought the property 5 years ago. If you bought the property 5 years, I recently had a client. Their prior tax preparer put everything at 27.5 years. All the assets at 27.5 years. They've gotten no benefit of the assets in the property that depreciate faster than that, and so they're a great candidate for an election to change that method. They bought the property 5 years ago, and we haven't taken the depreciation that we're eligible for. So we want to do a catch-up. So this catch-up is available. It's an election that you can do. It's a pretty standard election you can do in your tax return that allows you to catch up to what the bonus depreciation or the depreciation should be, and then you'll be able to be aligned from then on. So then let's talk about 10 and 20 years ago. So 10 years ago, you still get a benefit from that, right? If you take that, if you do that cost segregation study and you bought the property 10 years ago, you still might be able to get some benefit. But as you think about it, because this really only benefits 15-year and less property, if you bought a property 20 years ago and you do a cost seg, you're not going to get much out of it because you've effectively depreciated a lot of that value to begin with. Now, I'm talking about a lot of stuff. This is absolute gibberish to the average person. This is an elite group of people. This is not entirely gibberish, but I hope that some of this is making sense. Is any of this not making sense, or do you have any questions? Yes?
Is there a purchase price where it makes more sense to do, this sort of study? Or is there like a break point to where like it makes more sense?
Yeah, the question is there a price point where it makes more sense to do this kind of study or not? And that's a great question. I don't think that's part of the. I don't think that's a significant part of the consideration. I know that there's people doing millions of dollar property and then hundreds of thousands of dollar property, but that's a great question, and we're thinking about. I love thought experiments like that, but I can't think of anything right now. Yes, Patrick.
Are there a lot of companies that do these cost segregation reports, or is
Yeah.
it like a competitive thing where there's only 2 or 3 providers
Yeah.
and you're always in a lineup waiting for them?
Yeah, that's an interesting question. There are a lot of people that are popping up that are doing this, there are a few major players. Like if you go to AI, you'll find that there's a few major players, and then what's really important is that there's certain databases that are out there that have the IRS-approved pricing for different assets and things like that. And there's one of the references that I provided earlier was related to the methodology that's allowed by the IRS. So all those publications. So there's a smaller number of people that actually have the keys to the kingdom on that, and then there's a bunch of people coming out and saying, oh, we have something better and ours is better. But I have to think that a lot of those people might be using similar types of tools that are out there. But the most important thing is what I think like for someone like me that's doing it, I say, hey, I'm not some Johnny come lately. I'm actually working with tax. I help people with actual tax strategy, and I'm not going to give some people a highfalutin claim as to what the benefit's going to be. I'm actually going to help them say, this is going to be your benefit, and this is going to be the ramification of you doing that. So that's kind of where I come in. But does that answer your question? Yeah. Yes, Madeline.
New STR with 100 hours.
Yeah.
Does that mean that you've rented it for a week?
So new STR with 100 hours is the question. What does that mean? So with a real estate professional, you have to have 750 hours per year in order to be considered a real estate professional. And I believe that the other rule is that it has to be higher than any other role that you have. So for a full-time professional, they effectively would have to have 1,000 hours. They'd have to be working like Elon Musk or something like that. That's ridiculous. Now, with short-term rentals, you can, if you perform 100 hours of work on the property and you perform the most work, more work than anybody on that property, whether it's property management, like there's a number of things you could do to get that 100 hours. People are fearful about this. Like I have a property, like Airbnb manages my reservations. Don't they spend? No, they don't spend any time. There's a computer behind that. Like there's like you are single identifiable person. Okay, so let's say you have a maintenance crew that comes out and cleans the place. Oh, the maintenance people spend 300-400 hours a year to clean the short-term rental. But guess what? That's not one person. That's any number of people that may or may not be cleaning the unit. So that's not an individual. If that does that make sense at all? So like a cleaning crew. Yeah.
What if you use it for your own personal sometimes, but you're also renting it out?
Exactly, and we have that situation too. That's a great question. The question was if they're using it for their personal property sometimes, but then they are also renting it out. And that is what that is. So in the tax code, when we create a short-term rental for a client, when we're doing a Schedule E, a lot of us are familiar with a Schedule E, the type of property that we're creating for a short-term rental is a vacation home. So that's going to be a vacation home. And then with the vacation home, there are direct costs and indirect costs. So like, for instance, let's say you use the property 50% of the time for personal use, but then you rent it out the rest of the time. So let's say your electricity is $100 a month. So your direct costs are $50 a month, but your indirect costs are $50 a month. And so that's how the return goes. And so there's a direct and indirect component to that, but that is actually the way to do it. And I think the Schedule E with the with the vacation home thing and all that, I think that was created well before Airbnb ever existed, but that's the way that it's done. Great question.
Work in Texas?
That is the great question. I love that question because that's the reason I'm an enrolled agent, because I can work in any state.
Oh, great. Okay.
Yeah.
Thank you.
I love being a CPA, but I also love enrolled agents are people too, by the way. Yes.
A question on audit risk for this type of cost segregation.
Yeah.
Once you prepare the report, and it depends on which one.
Yeah.
If somebody gets audited,
Yeah.
do you show up at the audit with them to explain what you did?
Yes.
Or-
Yes.
Yeah.
Yeah, so, okay, so all of these providers for the cost segregation that are out there, so I'm not the only one. So people that are out there performing, that are providing the service of cost segregation, they will often provide as an additional cost audit support. Now, I haven't personally experienced audit support by any of those people, but so I don't know what the degree is that they'll back you up, because like if the IRS comes after you and says this is a sham. Not only are we not going to allow you that deduction, we're going to penalize you for a fraudulent return or something like that. Something horrendously scary like that. I don't know what degree that they would support them. But for again, back to me as a tax preparer, and I'm gonna first of all, I want to be my position is that I'm going to do my darndest to be able to believe that every single return that we're doing is supportable by the standards that are necessary. In this case, it might be a more likely than not scenario that it'll be upheld by the IRS. But but these things are audited. And to answer your question, Joe, I have not been audited for these, but we're going through all of the scenarios to really understand what they might pick at, and then try to anticipate those issues. But yeah, anytime you have a Schedule C or a Schedule E, there's additional possibility of risk. There's a heightened level of possible audit risk, but we try to manage that and not do anything frivolous. Just if it sounds too good to be true, it probably is. That's back to that situation of if it looks sensationalistic, it probably is. You know what I mean? So. Great question, though. Any does that help, or is that okay? But all right, we'll keep going. But thanks a lot for the great questions. All right. Applying the right kind of study, challenge 2. Okay, so on the left we have I think we have like an NBA basketball player's home or something like that, and on the right. And then on the right, this is like the home that like 10 of us here that grew up in. So on the left, what kind of study would we want to do for this particular property? Would we want to do engineered, or would we want to do engineer reviewed?
Engineered.
And what about on the right? Because could we make a case on the right? On the right, do we want to change that? Right on. Yeah, so you get the idea. So like if you want to get if you have a lot of really gnarly features, I was gonna try to find a picture of like one of those TVs that come up out of the floor and stuff like that, but we don't need to belabor that. I think the outdoor stuff. But yeah, if you get Newport Coast, that looks like the Hollywood Hills or something like that. If you get one of those places, spring for the fully engineered report. But in any event, but we're going to get into the actual process of the cost segregation. So it's relatively straightforward. By the way, how are we doing on time, Joe? By the way, okay, good. All right. So the day of. So what we're going to do on the day of is well, on the day of, and I say that, but what we're going to do is some pre-work. First of all, when we're going to do a cost segregation study, we want to get everything that you have available to be able to assess as much as we do as much homework as we can before the actual day of the segregation study. So we're going to look for appraisal report, inspection report. We want to look at your tax assessment. And then we just want to get an overall idea of like what's going on the property. What kind of cool features do you have? What kind of cool installations do you have? Things like that. And also what kind of improvements you've done. And we'll get into that in a second in terms of when you're replacing a valuable property with another valuable property. There's a partial. I'll see the term in a second. But in any event, there's a process for that. And then we want to anticipate as much of what we're going to see as possible. Then we want to start understanding, what do we need to take pictures of? What do we need to measure? Things like that. So, like in several of the cases, what we've had is like, like we did a multifamily home, and then and all of the people were home at the time that we did the cost segregation study. And so, of course, we want to make it very dignified for the people that are living there. We arranged it. In this case, in one case, we arranged it on a day that there was some maintenance taking place, and so we had a good excuse to just come on in and kind of get in there and take some pictures on that. But if you do have occupants that are in the property, we just want to arrange the time to get in there. We want to take as many photos as we can. I like to take photos from every corner of the property. And then some of the most important things when you're inside the units are like I said, the countertops, the flooring, the bathroom fixtures, and your window coverings. The window coverings is also very important, and things like any internal appliances that may exist. Like for instance, if you're doing the tankless water heater, or you're doing any fancy things like that, we want to get all that. Want to get all those measurements, and so interestingly, we can use Google Earth for a lot of stuff. But what we want to do is we want to get the lengths of fences. We want to know what kind of fence. There's chain link fences, and then there's wrought iron fences, and there's really fancy fences and things like that. We want to capture those because obviously there's a significant price difference between a chain link fence and a wrought iron fence. And then even with trees and plantings, we want to see how many peach trees do you have, how many lemon trees do you have, what is the area of grass that you have, and then all of the hardscape. So all the cement areas, all the walkways, all the patios, and even balconies. So like if we have a second floor unit, if it has a balcony, we want to take all the measurements. We want to take all the railways and things like that. And things like and there's oddball things, and I'll show you a couple of pictures later. A few oddball things that we come up with. So, for instance, Tesla chargers or your EV chargers. Another one is retaining walls. Retaining walls are really expensive to replace if you've ever done a retaining wall. And so, like a retaining wall in and of itself is like if you didn't know what it was, it'd be kind of unassuming to look at, but to actually replace that could be an enormous undertaking. So there's things like that. Then we just crank all that stuff into the system and then generate the results, and everybody's happy. It usually takes around a week, by the way. But any questions about that? Any comments about any of that so far? All right. So far, so good. What's that?
You can deduct the retaining wall, and there's value in the cost segregation for a retaining wall.
Exactly. So the retaining wall, the retaining wall itself is I think it's a 15-year property. So the retaining walls. So here's a couple of pictures. So on the left we have a very basic retaining wall that's only about 18 inches tall, and then we have a retaining wall that's like 20 feet tall. And but both of those things require significant engineering and preparation in order to be able to hold up. I had a property in Lake Forest where we wanted to put a pool in. We had a retaining wall up against a hill in the backyard, and the undertaking just to move a retaining wall 6 feet back, like, you got to be kidding me. It's like parting the Red Sea or something like that. But anybody else have anything? All right, good. But yeah, that's your retaining wall. All right, so a few things to be aware of. These are the gotchas. These are the things that might affect your return for the year and things like that. So we want to make sure that we think about that. So the recapture. So, like, again, the government isn't doing this to be nice. They're doing this to promote the economy and things like that. But if you take that bonus depreciation, if you take that cost segregation, get that depreciation, and then you sell the property, you'll have a gain there that's a built-in gain that you'll need to recognize if you sell it. And the way around that is to do a 1031 exchange. We have a 1031 exchanger here, which is awesome. But here's the challenge. You have this challenge, and we've talked about with Joe a time or two. Like, we have to be aware of basis. So when we take a property, let's say we have that $1 million property. We take $200,000 in a bonus depreciation. Now our basis in the property is now $800,000. So if we were to do an exchange and convert that to another $1 million property, that $1 million property now has a basis of $800,000. So we can only cost segregate based on that $800,000 rather than the $1 million. And that's the catch that I think that people need to be aware of if they want to like do the rinse and repeat, quote unquote. So, it is still feasible to deal with that. Floor plan pricing. There's a couple of different options. If people are getting into like factories and really large buildings, let me know. We can deal with that. Oh, it's the partial dispositions that I was talking about. So I think that Brian, I think you were asking about if you can do bonus depreciation multiple times on something. So, like, say you have a kitchen, I got the granite countertops, I'm going to take bonus depreciation. Get that? Awesome. I say, I don't like these beautiful granite tops. I'm going to go with the quartz. So we're going to destroy the granite and then replace it with quartz. There's a partial disposition process where you'll have to recapture the original, and then you can redo the disposition on that. So, but the older value, but you still might get a net benefit because the older value might have been less of a depreciation than the newer property. So you might still have a net benefit. A few other things here. So we can get into more of the. Let me see if there's anything. So, passive activity. Yeah. So I think the biggest thing is for loss limitations, you just need to be aware of that. You might be limited by the amount of income that you have, or you might be limited by the amount you have at risk. So that you might have to carry back or carry forward some of the things. So you might not get all the benefit in 1 year, but it's still good to have in a lot of cases. So let me stop there. Any questions at the moment? Yes, Joe.
There's one more way to get rid of depreciation recapture.
Tell me.
Death.
Yes. Yeah. In fact, In fact, by the way, that's a great point. We are going to have. We're going to. On the last slide, we have a number of different strategies relating to tax, and inheritance is a big one. But we're also going to have a stump the CPA part, so you all can get your loaded questions ready on that. But I think that's one of the topics that we'll cover. So back to a little fun exercise here. So a couple of things here. So let's look at this. If you could see this, you can't really see my mouse, but in the top left sucker, what would we call this thing in the top left? Does anybody have any description for that? I love it. 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 Okay. Yes. I love how everybody went to the outhouse concept, but it is an actual it's a shed. I love the she shed concept, but it's a cool shed. But here's the thing with the shed, it's actually made out of really nice wood. It's got a cement base, and it's wired, and inside there's all kinds of shelves. So what is that? It's not part of the, it's exactly, you make it like an ADU, it's an ADU there. No, but what the thing is, like, how do you value something like this? So it's got the wood structure, it's got the cement base, it's got the electrical, and you know, so what we did, we treated it as a 15-year property, and we combined all the features that it had, and then and did that. But this is an interesting scenario because it's built off a lot of things. And then in the top right, that's another retaining wall situation. It's not as interesting since we already talked about that. But in the bottom left, so that's your Tesla charger. But if you look at that walkway, what do you see about that walkway? Anything interesting or noticeable about that walkway? It's not a test question or anything, but you know, the thing about this is that there is the fencing, or there's the railway system there. So you have the cement walkway, and then you have a railway, railing, and then of course you have the Tesla charger. So all those things are different things. So all of those things are different depreciation periods. So you want to make sure you capture all of those and don't miss out on anything. So anyway, and then on the bottom right, it's a similar situation. So we have a gazebo, we have a hot tub or a jacuzzi or whatever we want to call it, and then of course we still have we still have a concrete pad. And in addition, even though this is an above ground jacuzzi, it's not built in, you effectively have to build it in because it is hardwired. It is permanently wired in. So that is in fact a depreciable asset for the purposes of cost segregation. But one of the questions is how do you value something like this? You have this gazebo that, you know, we can all imagine what a price would be in Southern California to replace that. And then the jacuzzi itself, those are cheap as chips, relatively. Probably you can get those $7,000-8,000, maybe $15,000 brand new. But then you have the cement pad, of course. The cement pad is still rather costly. And then of course the electrical wiring. And when you think about the wiring, it's not just wiring an outlet for that unit. It's also wiring from that unit all the way back to where the electrical box is, which can be 50 or 100 feet sometimes, or sometimes more. Yes?
So is there, like, let's say I have a hot tub or whatever, and it's a plug-in. I don't even know, I don't know if it's a 110 or 220.
Yeah.
Is that one that can be used as an asset, or does it have to be hardwired and then it counts?
Yeah, that's an interesting question. If you're buying it for the purpose of the business, I think the IRS would allow you to, like, if you get one of those 120 volt things. And I'll tell you why. Like, for instance, with a lot of these, this is one of those trust but verify. So what we'd want to do is really look at that in detail and let's get an assessment for that. But I think that they would allow it based on the fact that, so for instance, Airbnbs. A lot of people will buy an Airbnb and they're saying, I'm not going to rent this Airbnb out if they don't have any features. I got to have nice countertops. I got to have nice bathrooms, and let's put in a hot tub. Because, like, I know a number of people that have a property in out by Palm Springs or something like that, and they'll put in a hot tub or a pool or whatever. So there's things like that, and as long as it's for business purposes, I think that they would allow it. But I think that would require further review. That's a great question. Yes.
I'm just curious, let's say you buy it at a higher price than what the value is maybe a year later when you do the cost segregation.
Right.
Or, when you sell the property.
Right.
How does that impact your taxable income? Or, is it just you take the loss on it, so there's no benefit to this?
That's a great question. So the question is, if we buy a property in 2026, and God forbid that in 2027 the value has gone down for some reason, and then we do a cost segregation, then is the cost segregation now going to be less than it was? There's a few different. And to answer your question, I suspect that it would probably be flat or very close to it because we're also in an inflationary period. So even though property value itself might go down, like the stuff that is in that property might not be going down that much. But you know, we don't want to guess on that. But what we can think about though is, so when we do the cost segregation study, we can base it on appraisal, tax documents, and I think there was one other thing, like, or purchase price, I guess you could say. So there's the purchase price, there's the appraisal, and then there's the tax value assessment. So those are all things that we can use as inputs, and we can use the one that makes the most sense. And so let's say it does go down to 10%. Does that mean does that mean that the value of the stuff for cost seg goes down 10%? I don't think so, but maybe some percentage of that. I guess that might be a good argument to possibly do the cost seg sooner than later. But you know, that's a great question, but I think that that would be hard to answer. But I think it would. I think if I was to think about it, I think it might be in the flattish range.
Thank you.
Anybody else have anything? All right. We are getting there, folks. We are getting there. Here's the heirs. So thank you for that one, Joe. But so what we want to do right here. I know you all are very busy. It's getting late, and I want to respect everybody's time. I want to respect Joe's time. But I'm more than happy to answer any questions related to real estate, tax incentives, and things that are available. And this is just a small sample of all the different tax incentives that are available, and I can talk to you about why some of those are. But and then we can also, I'm also happy to do a Stump the CPA. Madeline just gave me a great Stump the CPA question. I love that, but you all are way smarter than me. You all have a lot more experience, so you know it's not very difficult to stump me. But if there's anything else that we want to talk about, anything. But a few things that I do want to mention though, like mileage and travel deductions. I'm seeing a lot of people that are investing in real estate that are missing those. They need to really document the mileage that they drive to the properties and the travel deductions. I always say golf is won on the short game. It's like if you're making 20 trips of 70 miles each, that's a few $100 that's due back to you. So why wouldn't you take it? I know for some people that's not much, but why wouldn't you do it? Another thing is for if you're an active participant and you buy a vehicle to go to your different properties, things like that, you might be able to take bonus depreciation for that. But I want to stop there. Any questions or comments? Any of these things that they might want to cover? All right, I've said too much, no. But Joe, I think we can pass it back over to you. But I think we covered the main stuff. Thank you.
Thank you. Very, very informative. Any other questions? No? Yes.
Yeah.
I didn't hear the entire question. Is there a I don't think there is
On
a
the cost
max
seg,
limit, is there?
yeah, and it's you can get a cost seg for whatever you want, but you might have to carry it forward or carry it back if you don't have enough income if it generates a net operating loss. So if you
I think what he's saying is that the max limit is how much money you made that year. That's the max limit, because if you make more or less, then it has to be carried over to the next year.
yeah, you don't lose it; it just carries over. So
Yeah, that's actually a really good question, because
yeah,
if you're not making $1 million and you do a cost segregation and
Yep.
you're getting $1 million
Yep.
write-off, you're not paying any taxes at all.
Yeah.
But you get a $2 million cost segregation right off your writing it off. And you know, that brings up another question for me, is that you accelerate everything up front. Not everything, that's my question. Not everything is accelerated up front. So you still have deductions up to the 27 and a half years.
exactly.
But they're not as big as they would be if you split them up all at once.
Exactly. So the frame. Let's think of the frame of the house. The frame of the. So the frame of the house is typically your 30 years, and then, like I said, the pool is also 30 years or 39 years in the case of a short-term rental, 27.5 or 39 years, that is. Those are the ones that are going to depreciate over time, but that's still a significant amount as they'll be able to take. And those are also subject to the net operating and passive activity loss rules as well. We can talk about more about that, but yeah, it's still beneficial. And what I saw with a couple of people is that they put everything in the 27.5 year category, even HVAC stuff and stuff like that, and then they're really missing out on a lot of deductions. So that's where we really want to make sure that they get the right get the right timing.
Thank you. Okay, I've been holding this event for the last 10 years, and this event is live every month at the end of the month. I do have the next one planned. I think it's a financial planner coming next month or whatever. Hopefully I can see all of you next month. I also do meet with whomever would like to meet with me. My only requirement is that you buy me coffee or lunch. Okay, and if you're just starting out, I'm happy to talk to you and get you headed in the right direction. I see a lot of familiar faces that I've
We
met
have
with.
a meeting place we can.
If I don't meet with somebody during the week, I starve, I don't eat. So it's very important that you book an appointment with me, because if not, then I get really skinny, and that's not good. One of my assistants at work says that we always go out to lunch together. Like today, we all went out to lunch together. She says the only time Joe doesn't go is when he's meeting with somebody, and honestly, that's the only time I eat, is when I'm meeting with somebody. So please don't forget to meet with me.
You lost weight. You look great.
Thank you. Thank you. Please, does anybody have any real estate related questions they need to ask? Yes, no? No? Yes? Okay, well, if not, then please, hopefully you heard somebody here that's very interesting and that you want to speak to, and please reach out to them and talk to them, and maybe you guys can put some deals together. The battery's going. You're yelling at me like my wife.
You're doing it wrong.
Are you my day wife or something? Hold it. Okay, well, thank you for coming. I appreciate it.